Hello and welcome to Primus Trading Academy. My name is Primus and I'm excited to take you on this journey into the world of Forex trading. Whether you're a complete beginner or you have some experience but still struggle to understand the Forex market, this course is designed to give you a clear and structured foundation to help you become a confident trader. So Forex trading is often seen as complicated and risky, but with the right knowledge, discipline and strategy, anyone can learn to trade successfully. And that's exactly why I created Primus Trading Academy, to simplify Forex education and make it accessible to everyone. So before we dive into Forex, let me introduce myself properly. I go by the name Primus and I'm the founder of Primus Trading Academy. Like many aspiring traders, I started with little knowledge and faced many challenges along the way. I remember the confusion of looking at candlestick charts, price movements, and complex Forex terms without having a clear understanding of what they meant. So through years of learning, testing strategies, and mastering market psychology, I have built a strong foundation in Forex trading. Now my goal is to help you watching me, skip the unnecessary struggles and provide you with the exact knowledge and mindset needed to trade effectively. So at Primus Trading Academy, I believe in practical, real-world Forex education. My teaching approach is simplified, no complicated jargon, just straightforward explanations. Action, you learn how to apply concepts, not just memorize theories. And professional, you're going to learn trading the right way with discipline and strategy. So if you are serious about learning how to trade Forex profitability, then you are in the right place. And what to expect from this course is understanding the basics of currency trading. This is not just another random Forex tutorial. This is a step-by-step Forex training designed to help you grow from a beginner to skilled trader. So in this course, we will cover the basics of Forex trading, understanding what Forex is, why it exists, and how it works. Let's dive in. Here's an outline of what we'll be covering. Each section will give you a clear understanding of how Forex works and how traders participate in the market. So the first section is what is Forex. In this section, we will start with the basics, what Forex is and how it operates as a global marketplace for exchanging currencies. The next one is why trade Forex. Here, we will explore the benefit of Forex trading, such as the liquidity, 24-hour market access, and potential profitability. The third one, which is the key players in Forex. This is just understanding that not everyone in the Forex market is a retail trader. So we look at the major participants, including central banks, financial institutions, corporations, and individual traders. So in the fourth one, look at the currency pairs and quotes. So this is knowing that Forex trading involves trading in pairs. We will explain the major, the minor, and exotic currency pairs and how exchange rates are quoted. So lastly, we will explain how the Forex trading works. So finally, we just have to discuss the actual process of trading, how traders buy and sell currency, make profits or losses, and how price movements are analyzed. So this structured approach ensures that by the end of this course, you will have a solid understanding of Forex trading and how to get started. Now let's jump into the first section. Let's dive into what is Forex. Now, first point that we know here is that Forex is also known as foreign exchange. You understand? FOR means foreign, and then the EX actually stands for exchange. Simple, right? Now, so the second point here is Forex is the global marketplace for trading currencies. Forex is known as what? The global marketplace in which currencies are being traded. It's a decentralized market, meaning that it has no central exchange like the stock market. Also, it operates 24/5 and has a daily trading volume of over $7 trillion. Forex operates 24 hours a day and 5 days a week, connecting traders from all over the world with a trading daily volume exceeding $7 trillion. Therefore, Forex is the largest and most liquid financial market in the world. So traders buy and sell currencies to profit from price movement. So at its core, The forex trading involves buying one currency while simultaneously selling another. So traders aim to profit from price movements as currency value fluctuates due to various economic and political, what happened in the economy of a particular country and all. So people trade forex by buying one currency and selling another. The goal is simple, which is to profit from price changes. Since exchange rates move on and down due to economic and political events, traders take advantage of these changes. Now, I want to give an actual scenario, for you to understand better. Now, let me imagine you're traveling abroad. For example, imagine you travel from Nigeria to the US, to the United States, and you need to exchange your naira for US dollar. When you get to the United States, you can't spend naira there. For the fact that you are spending naira in Nigeria, you can't spend naira in the United States. So if the exchange rate is good, you might get more dollar. When you return, if the exchange rate has changed, you will end up with more or less money than you started with. So as we all know here, $1 is equivalent to 1,500 naira. So when you get to the United States, you took, let me say, 3,000 naira with you, and you got to the United States, and you walk up to the exchange booth and you want to exchange your Nigerian naira to the USD, and then you are being given just $2 for what? For the fact that 1 USD is equivalent to 1,500 NGN. I know most of you might still get this confused, but drop it in the comment section and let me know how I can help you. So now, this is how forex works, because traders make money by buying when prices are low and selling when the price is high. For example, you are trying to go back to your country and then you realize in the news that 1 USD is now equivalent to, let me say, 1,700 naira. Then you feel you need to pay more to get 1 USD. It's no more 1,500, it's now 1,700. Now you need to pay more to get 1 USD. Are you with me? So I hope you understand better. And if you don't really understand, just drop it in the comment section. I'll reply to you and I'll give that detailed explanation, because the reason why I'm making this video and my goal is to make forex simplified for you all and to make you understand. Now let me just give another simple actual scenario. A Nigerian company buys goods from China and must pay in Chinese yuan. So if the exchange rate changes before they make payment, after the goods is bought, if the exchange rate changes before they make payments, they might pay more or less for the same product. So forex trader, they take advantages of this price movement daily, using different strategies to profit from changes in currency values. So before we end this actual scenario, let me just ask you a simple question. Why do you think exchange rates change daily? Yes, the answer is because of things like government policies, economic news, and supply and demand. You see, the news, the economic, the political events, supply and demand, government policies, all these things affect the exchange rates daily. Now, let the second question go, which is this. If two countries are doing business together, why is forex important? So the answer is because they need to exchange their currencies to complete transaction. Next, we'll discuss why people trade forex and the benefit it offers. Now, why trade forex? Forex, as we all know, is one of the most popular financial markets because of its unique advantages. Here's why traders prefer forex over other markets. The first one is high liquidity. Trillions of dollars traded daily. Liquidity means how easily you can buy or sell something without affecting its price. So in forex, over $7 trillion is traded daily, making it the most liquid market in the world. Let me give an actual scenario for you to understand. So imagine trying to sell a product in a local market. If there are many buyers, you can sell quickly at a fair price. But if only a few people are interested, you might have to lower the price. So in Forex, there are always buyers and sellers, so trade happens instantly. Now let's go to the next one, which is accessibility. So in accessibility, anyone can trade with internet. Anyone with an internet connection can trade. So Forex is open, 24 hours a day, 5 days a week, allowing people to trade at their convenience. So all you need is a device and an internet connection. No need for a big investment. So in an actual scenario for this, let me just say, a random student or office worker can trade Forex early in the morning or late at night because the market never sleeps during the week. I hope you understand. Now the third point here is leverage. I know we've all heard about leverage, but as my students, as people that really want to learn about Forex, I want you to understand just how it's involved in Forex. So leverage allows traders to control a larger amount of money with a small investment. So brokers offer leverage so traders can maximize their profit with minimal capital. So now I would have explained about who a broker is because I made mention of it in leverage, but I guess that should be in our next class, because it's actually, let me just give you a brief explanation about it. I want you to know that a broker is an intermediary between a buyer and a seller. For someone that is willing to buy, there will be a seller at the end of the tunnel, and for someone that's willing to sell, there will be a buyer at the end of the tunnel. So a broker connects both of them. I hope you understand. Now the fourth one, which is the profit potential. That's we earn in rising and falling markets. Both when price is rising, we earn, and when price is falling, we earn. So unlike the stock market where you only profit when prices rise, Forex allows you to make money whether prices go up or down. The name for buying in Forex is called bullish, or selling, which is going short. Another name for selling in Forex is called bearish. So let me just ask simple questions from you guys. So why does high liquidity make Forex trading easier? Okay, the answer is this: because it allows traders to buy or sell at any time without significant price changes. Now the second question goes thus: how does leverage benefit Forex traders? Exactly, because it enables traders to trade with more money than they have, increasing their profit potential. Next, we'll talk about the key players in the Forex market. I want us to talk about the currency pairs and quotes. Now under these currency pairs and quotes, we are going to be learning different type of currency pairs. The first one is major pairs, the next one is minor pairs, and the last one is the exotic pairs. So firstly, with the major pairs, they are mostly USD based. So the major pairs are the most traded pairs, which include strong economies like the US, the Europe, and Japan, the Great Britain, and so on. And a sample of currency pairs that are major, we have the Euro USD, we have the GBP USD, we have the USD JPY. So concerning these currency pairs, I will just briefly explain it in this lesson, whereas in more lessons to come, I will give you a detailed explanation on understanding what the currency pairs and quotes mean. So now let's talk about the minor pairs. Talking about the minor pairs, they are popular pairs that do not include the US dollar. And the sample are what? The Euro GBP, the AUD NZD. All these pairs you see actually have a real name, and they have the country they belong to and the currency traded in those countries. So that's why I'm going to give another course explaining everything you need to know about the currency pair and quote, so that you don't look like a novice when seeing them in your charts or when you want to place a trade or whatever. So the last one, which is the exotic pairs. The exotic pairs, it include one major, one major pair plus one emerging currency, just a developing currency. So example, like for you to understand better, is just like a mix of a major currency with a currency from a smaller or emerging economy. Now, forex trading involves, buying and selling currencies based on price movement. So we buy when expecting the base currency to rise, which is also known as going long, and we sell when we are expecting the base currency to fall, which is known as going short. I know you guys will be wondering, what exactly is base currency? What is it talking about? I would have loved to explain, but it will require a very detailed explanation. So just drop your comments, anything you've not understand from this course, drop it in the comment section and I will attend to it. Now, let me just give you a brief explanation. There's something we call a base currency and a quote currency. See, for example, in the Euro USD, the base currency is known as the Euro and the quote currency is known as the USD. So in something like the Euro USD, it means that everything that we are trading upon, like what the price is based on, is the base currency, which is the Euro. For example, GBP USD, which is Great Britain pounds, but against the United States dollar. So in a situation like that, the base currency is GBP, while the quote currency is what? USD. So that means that we are trading the GBP stroke the USD. So the price movement is based on the GBP. So we are trading the USD against the GBP. I don't know if you really understand, but I have to just give another class for it. So if you already understood about it, congratulations. But if you haven't understood anything about this base currency or quote currency, drop it in the comment section and let me attend to it in the next class. So now, we buy, which also means going long. Another name for buying forex is going bullish. I get me. So we buy when the currency is expected to rise, because traders buy to sell later at a higher price for profit. And also we sell when the currency is expected to fall. Traders sell it first and buy it back later at a lower price. So let me just give an example. For example, you are buying the Euro USD. A trader buy Euro USD at 1.1000 and later sell, that 1.1000 means the exchange rate. Are you with me? So when a trader buys it at that exchange rate and later sell it at the rate of 1.1200, this means that the price increased by 200 pips. You guys need to understand about pips, but let's just say the price increased by 200. What does that mean? The trader is in profit. So I hope you understand. Now let me just give a simple explanation. Imagine you buy a product for $110 and later you have to sell it for $112. You make how much profit? That's $2 in profit. So in forex, the same concept applies. You buy low and sell high, or sell high and buy low to make a profit. So you make profit by either buying or by selling. So forex trading is all about predicting movements, price movements, and making smart buy and sell decisions. So the forex market is actually made up of different participants, each playing a role in the buying and selling of currencies. So these key players influence the market in different ways. We have the central banks, we have the commercial banks, we have the hedge fund and institutional banks, and we have the retail trader, which is us. So let me explain it for you to understand better. We are talking about the central banks. In short, they influence currency value. So the central banks, such as the Federal Reserve in USA and the European Central Bank, the ECB, controls a country's money supply and interest rates. What do? They print money and set policies that affect currency values. They are one of the key players in forex, the central banks. They print the money and they set policies that affect currency value. When the central bank raises interest rates, its currency usually strengthens, and when it lowers interest rates, the currency often weakens. So for example, let's say if the US Federal Reserve raises interest rates, the USD may strengthen because investors want to hold US dollar to earn higher returns. Now let's go to the commercial banks. Under the commercial banks, they process large transactions. So these are big financial institutions like JP Morgan, Citibank, and HSBC that handle large currency transactions. So they provide forex services to business and individuals, and also they trade currencies for profits and help manage risk for their clients. For example, a Nigerian business importing goods from China need what Chinese yuan, which is the CNY. A commercial bank helps exchange naira for yuan at the current forex rate. Now the third one, which is the hedge fund and institutional bank. These people, this set of players in forex, they do what? They trade for profit. So hedge funds and investment firms trade forex to make large profits, invest billions, and influence market trend. And their trades can cause sudden price movement because they trade with big money. They trade in a big way that can influence price movement itself. For example, a hedge fund believe the GBP, the Great Britain pounds, will weaken due to economic uncertainty. So they sell what? They sell large amount of GBP, pushing the price down further. So there are still a lot of things you need to learn about this when you finally get to the technical analysis aspects concerning your strategies, and there are a lot of things to learn in forex, and there are a lot of things to know, and the learning never really actually ends. But for the basic aspect of it, you really need to know, because when you now get to the advanced aspect, it will become easier to understand. But as time goes on, you are going to know more about it. Now let's go to the last one, the list, which is the retail trader, you and me. So the retail traders are individuals like you and me who trade forex through brokers. As I explained to you earlier, who a broker is, which is an intermediary between a buyer and a seller. So we trade through brokers. So we use the trading platform like MT5, MT4, the MetaTrader 5 or MetaTrader 4 to buy and sell currencies. And also we trade with smaller amounts compared to banks and hedge fund. And most retail traders like you and me, we also use leverage to trade larger positions with less capital. So for example, just say a retail trader notices that Euro USD is rising and decide to buy. If the price increase, they make what? They make a profit. Now there's this simple question I need to ask: who moves the market the most? I know you all have been wondering who exactly moved the market among these four. The answer is this: the central bank and hedge funds. You see, the central bank and hedge funds have the biggest impact on forex prices. Why? Just we retail traders, we actually make up a small percentage but can still profit by following the market trend. Now to the conclusion. Forex is a global market for currency trading, and to conclude everything, Forex is a global market for currency trading, and the market is open and traded 24/5, which I mean by 24 hours a day and 5 times a week, offering opportunities for traders to profit from price movement. So we've covered the basics: what Forex is, why people trade it, the currency pairs, how trading works, and the key players involved. So understanding these concepts is just the first step to become a successful trader. So as we move forward in this course, we will dive deeper into how to analyze the market, manage risk, and develop profitable trading strategies. And the last one here, as you already know, just absolutely anyone with an internet connection can trade. So there's something I want you to know: Forex is not a get rich quick scheme. If you'll be looking for a business that, okay, I just need money, I just want to earn money, I will advise you to look for something else, because Forex is not a get rich quick scheme. It requires knowledge, patience, and discipline with the right mindset and skills. So anyone can navigate the Forex market successfully. Just continue learning. Now, thank you so much. I really appreciate you for watching this lesson of Forex trading. And if you found this valuable, please like, comment, share, and subscribe, because your support actually helps more people discover this content and learn about Forex trading. So, and don't forget to subscribe to this channel once again and turn on the notification bell so that you never miss future lessons. We have a lot more insightful content coming your way. Don't miss the next video. See you in the next lesson. Thank you.